Hey guys, Joseph James here once again with your newsletter brought to you by theschooloftrade.com. September 22nd, today was a Tuesday, a day before FOMC announcement tomorrow. I'll talk about the FOMC prep work in the market prep video, which will be coming out later on this afternoon. Before we go into our live trades of the day here, I want to remind you guys, please subscribe, rate, and comment on this video. Check out our YouTube page at /School of Trade. It's a brand new free resource, lots of information there. Let's take a look at our trade room totals. Now, as you guys know, we're making our way through this transitional month of September. Coming out of the summertime chop into the fall trading, we put $230 in our pocket today. That brings our total for the week so far to $270. And of course, you guys can see here, it brings our monthly total to $2190. And of course, weekly totals so far are $210, $600, and $1100. We will keep you guys posted as we make our way through the month of September. Now, the term of the day today is the 3-strike rule. Now, we looked at the 3-strike rule today on one of our trades. Didn't have to use it, but of course, we were looking for it. And what is the 3-strike rule? Well, basically, it applies to managing our trades. And it's used to identify a market that is seeing difficulty in filling our profit targets and ultimately shows signs of deterioration and a reversal to the opposite direction. The objective is to maximize profit and minimize losses. And I use certain tools such as the time and sales window and my trading dome. Now, how is the 3-strike rule used? Well, I'm going to give each market 3 attempts to fill our profit target. So whether it be the first target, the second target, or the third target, I'm going to give the market 3 attempts, right? 3 strikes. So it applies to all 3 targets. Now, if after 3 attempts, we do not see that target filled, right? We've all seen it happen. Price trades up into our first target and then backs off. Goes back up into our first target, doesn't fill you, trades into it, then backs off. Right? Well, of course, the third time it does that, if it doesn't fill my order there for that first target, I'm going to now manually take profit accordingly. So here's how it works. If the first target, which of course is a very close 3 or 4 tick target, if I have 3 strikes against my first target, I move my stop up to my point of entry to eliminate all the risk. Then I will look to, of course, take profit manually for my first target. The big concern here is that first target, I've got to move my stop up to entry. Eliminate all that risk. Now, if it happens on our second target, a little bit different. On our second target, if we see the first 1, 2, 3 strikes, and then we look to manually take our trade, at that point, we should already have our stop at our point of entry already. So in this case, I'm going to physically take my target, move it below price or above price to force that target to be filled. That, of course, is going to prevent me from letting my price come back down and stop me out without filling that second target. And of course, on your third target, we'll flatten our total position. Now, the third target is kind of different because we're going to be trailing our stop to begin with. So if you're using a fixed third target, you're really not following our rules. But however, there are some situations, they're few and far between, in low volume environments where we're not seeing much follow through, where you will place your third target a couple ticks above or below the next level of support and resistance that we expect price to hold to. So on your third target, ideally we want to be trailing our stop, so we wouldn't really have any position to manually flatten our position. But basically what we would look for here on a third target, if we did use a fixed third target, would of course be 1, 2, 3 strikes in your route, and then we'll of course flatten our position to make sure that we don't give back any profit that we need to. It's called our 3-strike policy, guys. And the 3-strike rule, basically again, it's going to maximize profits by guaranteeing that we get filled in that target and not filled in our stop. For target number 1, the most important thing is to eliminate risk first, then worry about your profit. Target number 2, the risk has already been eliminated, right? So in target number 2, it's important that we use patience and discipline, wait for those 1, 2, 3 strikes, and then look to physically take that target off the table by forcing that thing filled. And of course, for your third target, in the rare occurrence where you're going to have a fixed third target, 1, 2, 3 strikes, we flatten our position total. It's called our 3-strike rule, guys, and of course we use it every day in our live trade rooms. Come out and join us. The beginner's course is highly recommended for all free trial members. Give yourself a good jump start on your free 3-week trial with the beginner's course. We open up the room tomorrow morning at 2:45 a.m. It's available for trial members and lifetime members tomorrow, so make sure to come out and join us at 2:45. Now you can have the European session at 2:45, come join us for that, or come back and join us for the 8 o'clock U.S. session, 8 o'clock Eastern. So come join us at 2:45 for the Euro session, or 8 a.m. Eastern for the U.S. session. And of course, during those 2 sessions, we'll look at 3 jobs: identify, adjust, and execute. Let's talk about some of the trades we took today. Now here in the crude, here's your crude oil futures. Symbol here is CL. This is the front month 1109 contract. Now our first trade of the day here was a small winner, nothing to write home about, but another small winner here to pad our pockets. Of course, 8:35 this morning happened in the pre-market right before 9 o'clock. 8:35 here. This is a two-step short at 71.35. Now, this one was called as high risk in the market today because of the fact it was taking a little bit longer than 15 minutes to set up. As you can see, 8:12 to 8:35, just a little bit longer than 15 minutes. That was the reason why this is called a little bit higher risk. We saw increasing speed of the tape. Momentum was on our side and had that nice big double top up there just below that high of day. That really gave us the confirmation we need. That double top really is a strong indication that the buyers here tried once, twice, 3 times here now to push that thing above that high of day, and it failed all 3 times, then came back down and filled our order here for this two-step short. 71.35 in the market. We took 6 ticks out of this market, 3-tick target, took 2 off, 2 contracts off at 3 ticks, and of course that totals $60 there as we work our way through our day here. Now the next trade we took, 9:49 on the crude, making our way through the morning here. This of course was after we saw the US open at 9:30. We waited for 9:35, waited to see some volume come back in, and then the crude market took off. 9:49 this morning on a breaker short, 71.11 here. Now this is a great example, guys, of how sometimes we've got to have confidence in getting out of these trades early. Now on this particular trade, got in at 11, got out early on this one, got a little bit lucky obviously because I got a scratch trade out of it. But basically what happened was we saw momentum curl against us, and the pace of the tape went red, meaning that it slowed down. So as you guys know, we say this all the time in the room. Know when to get out of your trades. Do not get too attached to a trade. If you see it go against you, why are you waiting around to see if it's going to work out? When was the last time you saw a trade go 4 or 5 ticks against you and then filled all your profit targets? Very, very rarely. So we know statistically over time, when we see price go against us, it's better to cut your losses early and wait for the next one. This was a great example here. Got a little bit of a good bounce in this one though. We were able to see momentum curl early, and the speed of the tape really died on us, which of course is all I needed, right? Watching my pace of the tape indicator to get me out of that trade early, and it's protecting our capital nicely here. Now it wasn't long thereafter, just about 10 minutes, 20 minutes later there, at 9 minutes past there of 10 o'clock. Okay, so 20 minutes later on the crude, this breaker long at 71.35. Now this is where we made our money here. Targets, of course, at 4 ticks, 8 ticks, and then trailed our stop for additional 7 ticks, totaling 23 ticks in this trade. Now this is a great example. We showed this one live in the room. We were able to show how we took all the profit targets, how we managed our trades, how we used our trade management chart. Great example for all of our new guests. And another great example of a breaker long, a trend continuation pattern here that got us $230 on this, only a 4 contract account. So $230, all you needed, guys, was $4,000 in your account, $1,000 per contract on crude to trade like this with us. So guys, come on and join us, guys, tomorrow morning, and we'll show you guys how we take these breaker patterns, long, short, sideways markets, trending markets, guys, doesn't matter. So as you can see here, guys, $230 in this one, right? $60 in the previous one. You guys can see how we got to that $290 here for the day today. Only took 3 trades, and as always, guys, we do not overtrade at all. We're very consistently disciplined, patience, and waiting for only the best setups to happen. Now, this is another great example, guys, on the Russell. Right, as you guys know, we're using our pace of the tape indicator. Now, the pace of the tape indicator, for all you members and all you guests out there having a hard time learning how to read the tape, the pace of the tape indicator is the speedometer of our time and sales window. Now, that may not sound very powerful, but what it does is it allows us to see patterns on our time and sales window. And as you can see here in the lower left-hand corner, we were looking for a 2-step short here, but we saw that decreasing pace of the tape from yellow back down to red. And as you guys heard me say this morning in the trade room, that's one of the biggest concerns that I have. I love to take trades when price action is increasing. So we look for, of course, an increasing level on the pace of the tape. But in this example, we saw a decreasing speed of the tape. And that means in a marginal trade where we potentially have other factors, right, other layers of risk involved, if I see the pace of a tape indicator show this very easy to spot pattern where we have decreasing speed of the tape, that's always going to be a good heads up. And of course, once again, right, pace of the tape indicator, proprietary indicator, keeps that hard-earned money in our pocket by simply following our mechanical rules and knowing when to trade and when to avoid a trade. I want to remind you guys too, our live trade room opens up tomorrow morning at 2:45. We do free webinars 11:30 on Tuesdays and Thursdays. Tomorrow's FOMC day, so be prepared for that tomorrow, guys. Grab a copy of the beginner's course. Always recommended for all free trial members. Please rate and comment on this video. My name is Joseph James. I want to thank you guys for your time today. For more information about lifetime membership, drop us an email, sales@schooloftrade.com. And we'll see you guys tomorrow morning, 2:45 a.m. Eastern time for the European session, 8 o'clock Eastern for the US session. We'll see you next time.